Welcome back. Markets are under pressure this morning. Futures indicating a lower opening for the start of trading. Dow Industrials down 120 points. This as the 10-year Treasury yield sets a fresh 7-year high of 3.25% this morning. Joining us right now, the head of global research at Bulltick Capital, Kathryn Rooney, Vera. Kathryn, good to see you. Thanks very much for being here. Your thoughts on rates going up, and how worried are you about the level of the 10-year right now?
Well, rates have to go up, right, Maria, because we're expecting a normalization of the curve. We're expecting a normalization of the economic scenario. The yield curve should be steep, right, Maria? It shouldn't be flat or inverting. And that's where we're going. That's where we've been going for years. So now the Fed is getting out of the way with regard to manipulation of yields. I would expect the 10-year to move higher, and I would expect the yield curve to gradually normalize. As I said, yield curve should be steepening, not flattening.
But is that a problem for the stock market?
Well, I think the stock market is largely priced in. If you look at the Fed funds futures, Maria, the Fed guidance is fully priced in. So the market is already pricing in a December rate hike, a January rate hike, a March rate hike, and with increasing probability, Maria, September as well. And I think we all know the Fed is likely to hike 3 times next year. It's a good thing for the Fed to hike. That means that the economy is actually growing at a very good pace. And I would contend, Maria, that we're in a Goldilocks scenario. We still are, where inflation is very moderate.
So where do you invest in this type of environment? We all know that the bond proxy sectors, like what used to be the telecommunications services, staples, utilities, they usually underperform in this type of environment. What are you telling your clients right now?
I mean, it's very few times that I've seen fundamentals be so good in some emerging market countries and sentiment be so bad. So what I'm actively recommending has done very well for our investors in recent months has been emerging markets. Brazil just this Sunday had a landslide first-round victory for the free market kind of centrist right-wing guy. So I think that you can find some value even right now in emerging markets, especially when you have the IMF, the Fed, and all these multinationals really kind of putting a more bearish spin on global growth in coming years.
There's this narrative that things slow down quite a bit, not just because of demographic shifts, but because of interest rates going higher. That's why the IMF lowered the growth expectations for the globe for this year and next year. What's your take on how the backdrop slows down? Do you think we are going to see a slowdown from current 3 to 4% economic growth numbers? I'm talking 2020, 2 years out.
Right, yeah. Maria, they also contended, the IMF I'm referring to, contended that the slowdown would come on the back of trade war. And that was under the assumption that President Trump would follow through with all of his threat. My contention is quite the opposite. I would say 2 things. One is that the Fed, the IMF, the CBO have consistently underestimated over the past, let's say, 10 years, the negative impact of high taxes and suffocating regulation, overestimating economic growth forecasts. Now they're doing the opposite. So I think there's probably an error here. I think it has to do with dynamic versus static forecasting in economic growth. But I would also say, look, the trade war, I would contend that even if China cedes on anything, Maria, if China cedes on opening up the import market to U.S. cars or cracks down in a real way on intellectual property theft, then you're unlikely to see that jump from 10% to 25% tariff that the president has promised as of January 1st.
So you're not worried. You're not worried about growth slowing down right now. Kathryn, it's good to see you this morning. Thanks very much.
Thank you very much.
Kathryn Rooney, Vera there.